It's been a difficult year and you know, a very unique year in many ways. Q3 performance, our balance sheet, surprisingly, even in the pandemic, our balance sheet has grown. Our total assets have grown 27%. We've closed about 972 billion, just shy of 1 trillion. This was driven by deposits growing by 32%, and those deposits were then utilized in loans, which has grown by 19%, and the rest was parked in government securities. We've been very selective in terms of lending, given that obviously the risk factor in the environment necessitates us to be quite choosy about where we're going to lend. Now, with that growth in the balance sheet coming into the income statement, our net interest income has grown by about 24%. We've seen some subdued performance at the non-funded income lines, and that's primarily because of two main reasons. One, you do recall that the regulator waived fees for transactions below 1,000 shillings. So, you know, that has had a massive impact on our performance on service and commissions. And secondly, the FX income line, with the lockdowns globally, the economic activity was subdued, and that has impacted our performance on that line in particular. When I come to costs, costs have grown 20%, but that's largely because of the impact of consolidating National Bank of Kenya into our performance. You know, we acquired National Bank in Q4 last year. So when you're comparing the first 3 quarters of 2020 versus 2019, National Bank was not consolidated the first 3 quarters of last year. So it's not a like-for-like performance. So if I strip out National Bank and compare like-for-like, our cost has actually gone down by 1%. So from a corporate side of things, we haven't really been aggressive in terms of lending. With the pandemic, there are sectors that have been greatly impacted. You know, tourism, hospitality, airlines. You know, those have suffered a massive hit. Real estate, to some extent, we've seen a bit of recovery in terms of with the reopening of the economy, people being able to service their rentals, and as such, the customers our customers who are depending on rent being able to come back and say, we are now comfortable. The assistance you gave us, thank you very much. We can proceed with servicing our debt. Not entirely out of the woods on the real estate, but we've seen recovery. So when I look at those areas and link it to our income statement, you can now start to understand why our provision line has really grown over 200% increase in level of provisioning for loans, because we've got to take decisions based on international accounting standards on how we safeguard the quality of the asset. NPLs have deteriorated. Our NPL has gone up to, I think, the highest since I've been here, and you know, the market environment is what it is. Our NPL has closed Q3 at about 15%, and this is as a result of obviously what is happening from a key macros point of view. The environment we're operating in is putting pressure on the quality of the asset. So for Q4, we are still going to maintain a very cautious approach in terms of lending. We are lending as I said, very we are very picky and choosing the right level of asset. We believe that the pandemic will continue into next year. It's not about to go away. So we are planning on the basis of up till June, the situation will still not be back to normal, and then a recovery will start from June next year. When this pandemic started, one of the two things we were very, very clear that we must conserve was capital and liquidity. We were very clear that cash becomes king. and more than ever, cash is always king, but more than ever, during a pandemic, you cannot run out of cash, especially when you're giving moratoriums and supporting your customers. So the normal cash that you generate from business is impacted by the fact that you're giving customers three to 6 months moratorium to pay. I'm glad to say that we've actually been able to hit all our regulatory thresholds on capital. We do have a buffer on the headroom of capital, and also on liquidity. Actually, on liquidity, we operate in much higher than we were even before the pandemic started. So, I think the hawk-eyed monitoring of those two parameters is bearing fruits. NBK is a good story. It's a turnaround story. We are looking, and it was reported not too long ago in the dailies. We're looking to close the year with about $1 billion of profitability out of NBK, just a year after acquiring it, and also a year that is not normal. It's a year that is a pandemic year. So a lot of the things when we acquired NBK, we had set out to achieve. The environment was not conducive for us to do that. But the quick, swift action by management to refocus the organization has borne fruits, and we will deliver about R1 billion of profitability. Some markets within the region we operate in had acted differently in terms of how the government's response to the pandemic was. We know Rwanda went to a full lockdown. We know Uganda also went to a full lockdown. Burundi and Tanzania were not as aggressive. Kenya was somewhere halfway in between. So that has helped in many ways. Uganda and Rwanda, once they opened up, they were able to sort of catch up economically fairly quickly. So the contribution out of international businesses this year, we are expecting to see an increase, will be higher, especially at profit level, than it was the previous year. You know that most of the economies have opened up, not 100%, obviously. So the expectation is we will see Q4 performance being marginally better than what we've seen in Q3. And as I said, going into 2021, our expectation is the first 6 months will still be dealing with the pandemic. But I think most countries are learning to live within the pandemic and are not going to go back into full lockdowns. And hopefully that second half of next year is full recovery mode. I think people are learning to live with the virus. So I don't see us going back into full lockdowns. Remember, the performance of businesses is a function of response by government on the virus. So if governments go back to full lockdowns, which is not far-fetched, because when you look at what's happening in Europe, they've gone back to where they were in March, April. So is it a possibility? Yes. I mean, because we do not know, which direction this pandemic will take. But I'm hopeful that in the region we are in, we shall not go back to full lockdowns. For the remaining part of the year, it is really pretty much the same strategy we've had, is conserving cash, looking after your capital, and managing your costs, and letting the momentum of the business you've built take you to the end of the year. And next year we start by looking at increasing our risk appetite in the environment we shall be in. That would mean looking at lending some more, optimizing on the capital liquidity buffers that we have. How do we sweat that and make it work for ourselves? Getting the lines that have been subdued this year, like service fees and FX coming back as the economy starts grinding faster. You expect that activity on the FX counters also start improving into next year.